welcome to the Credit Connection. I'm Sarah Snell Cooke, sitting here with Mr. James Green. Welcome.
Hey, Sarah, thanks for having me.
Tell us what you're up to these days.
Yeah, absolutely. So for those of your audience who may not be familiar with me, my name is James Green. I am based in Tampa, Florida. I am the co-founder of Illuminate Advisory, and I'm also one of the global co-founders of the Resilience Think Tank.
Very cool. And so you guys deal a lot with risk and risk management and that kind of thing.
Absolutely. With Illuminate Advisory, we encourage organizations and individuals to take risk. And then, yes, the Resilience Think Tank is focused on the risk and resilience industry from a global perspective.
Very cool. So you have a great perspective, a global perspective, and certainly financial services kind of oriented perspective on risk. And so two of the things that I think have been or are the ongoing risks for credit unions are, one, telling their short story well and sharing that out. I mean, 100 years in business and still even credit union members sometimes or oftentimes don't know what their credit union really is and can do for them. And then the second thing I think, especially now with the fintech invasion, if you will, is finding the right business partners, including fintechs, who can help credit unions remain relevant for their members. So that's my take on the biggest risks. What do you see as the top risks for credit unions?
Yeah, well, let's start and let's talk about that. So I worked at a CUSO for a few years. That's where you and I first met. I have many credit unions as clients, so I guess I'm a credit union lifer, member of credit unions myself, several. And, you know, when it comes to brand, I think that's really interesting because a lot of times when I talk to members and I say, do you even know how or why your credit union founded or was started? Most people don't know. And I think from a marketing perspective, that's really important because you create those emotional ties. Like this credit union maybe serviced this part of the community when no one else would, or when there were hard times, or when there was, you know, discrimination against getting loans. And one of the big points of marketing is first to sell your product, but it's also to create those emotional bonds. That's why we see all these commercials around Christmas time with the Hershey Kisses and the Coke polar bear. We all know those commercials. And I think credit unions need to do a better job of creating that emotional tie, selling the purpose to their members. And then, yeah, a lot of times when we speak to members or we speak to boards, we say, are the members aware of all the products you offer? And most of the time they don't. And there's a lot, you know, you're just leaving money on the table. So we often find I may have a car loan with a credit union, but then I do my online banking or I have a credit card with a big evil bank. Marketing's really important for that. And I think it ties. So you talked about, you know, partners. What are the challenges with partners? Yes, certainly. I'm a Gen X, and if you're younger than me, which is most of the world now, right, you expect whatever financial institution you have to be able to mobile banking, online banking, remote, RDC, chat. These aren't even cutting edge anymore. These are requirements. Most credit unions outsource those functions, and they should. You don't have the time or resources to invest into code, into InfoSec, into cybersecurity, into all the things you need. But we're seeing more and more credit unions get burned based on the partners they choose. There was a rather large credit union in Florida last year. I'm sure everyone's aware of. Their mobile and online banking went down for 2 weeks. That's unacceptable. That's how you get changes in management. That's how people leave to pursue other opportunities. That's how you get a ton of regulators making you very uncomfortable. But that's also how you lose members. If I can't access my finances or my statements for 2 weeks, I'm leaving. And I think most members and most customers would say that's way too long. And the customer's not going to care. Well, we use a third-party provider for whatever it is, swipes. They're like, well, I pay you. I see your logo on the invoices, so I don't care. And regulators have also been very clear, explicitly clear since Sandy. You can outsource process as any type of financial institution. You do not outsource the risk. So that credit union I mentioned earlier, doesn't matter what happened or why, they're the ones who will have additional oversight. They're the ones who are going to get fined.
Yeah, especially when the NCUA doesn't have third-party oversight. They're fighting hard. And it's interesting because I think there's a couple different areas of risk you're talking about, and I'm pretty sure I know which credit union you're referring to. Tens of thousands, if not hundreds of thousands of social media comments and I'm sure messaging and call center and all that. So I think there's one, they're risking their, that risk is risking their brand, of course, and the members' trust and ability to serve them. Not that their money wasn't safe, but they didn't know what the heck was going on with their money, right?
Where is it? Yeah.
But also the public relations risk of something like that going bad, because there was a lot of news coverage on that as well. Yep.
And that's huge. And I think a lot of credit unions misstep. They're like, oh, well, we're going to waive all of our overdraft fees, or we're going to waive all our late fees. Or if you couldn't make payments to third parties, we'll even pay those. But to your point, it doesn't recover the brand. You can make someone whole financially, but that brand is damaged forever. I purchased something 2 months ago that I've been trying to receive. The company finally made it right, and it arrived at my house yesterday, but I will never order from that company again. So from their perspective, transactionally, James bought something, James received something. Credit union, you got late fees because you couldn't access your account. We waived those late fees. But the consumer, going back to that emotional part, I'm like, it took me 10 weeks and a ton of emails or phone calls. I didn't get that product, or I had no idea if my paycheck came in or if my bills went out. You can't ever, I think, recover from those kind of massive brand or reputationally damaging events, especially to your point in an era of social media. Now something happens regionally, we're all aware of it globally, and we're all aware of it pretty much in real time.
And it's a risk to the credit union movement as a whole too, I think too, because credit unions are kind of already less known for their tech savviness.
Correct. When you place an emphasis on customer service, what I love about credit unions, then you better deliver, because that is your product.
Yep, absolutely. The service. And it is not just a smile and a handshake at the front door anymore either, which I think I was talking with a client earlier today, and they were saying that they feel like some credit unions see their website, for example, as a necessary evil. And I'm just like, that hurt my heart for many reasons, but to not see the value in something like that, your website, which is your portal typically to your online banking, and helping the member and seeing it as a member service opportunity, it's hurt me.
Yeah, I think that's problematic a few ways. The first is generationally. Again, I'm a member of a credit union. My wife is, my family is, my kids are. The only time my kids were ever in a branch was when they were 5 and 6 to open up their youth accounts. They have never been in a branch since. They probably never will. So to your point, everything they do is on their phone. So not only do you have to have a robust and inviting website, it has to be rendered for mobile. I don't think my kids have ever done any banking in person or on a desktop. Mm-hmm. The other thing, I think we've seen a huge change, we all have, because of COVID. There was a long time there where branches were closed. And we're seeing even people who were traditionally more inclined to be in a branch got used to video tellers, got used to not going in. That foot traffic in a lot of branches I'm seeing is way, way down. So again, if you're relying on the friendliness and the smile and the handshake at the branch, your members may not ever be in a branch again. You have to have a way to convey that personal touch in a digital format.
Yes, and it absolutely can be done too, which is why your website is not just necessarily necessary evil. But
exactly.
So getting back to my question for you, I appreciate your commentary on my top threats. What do you what do you think are the top threats that credit unions could be facing or are facing and could be facing in the coming year?
Yeah, so two things that I'm seeing a lot of when I speak to boards and executives that are known but are continuing to change. The first one is cybersecurity. And when I ask credit union executives today, what's the biggest risk? Cyber is 1, 2, 3, 4, and 5. So that's not really, groundbreaking news there. But what I do find interesting, the FBI's official policy to United States financial institutions is do not pay ransomware. Under any circumstances, do not pay ransomware. I'm here to tell you, people are paying ransomware. And here's how I know. These criminal enterprises, these threat actors, they're either state-sponsored in some cases, right, or they're crime rings. They are in the business of making money. They don't commit a crime that doesn't make money. And ransomware is getting increasingly more effective and more sophisticated, which means these threat actors are investing in ransomware, which tells me they're not doing it just because they're bored. They're doing it because they're getting paid. So organizations are paying ransomware. The amounts they have to pay are going up. The level of difficulty to unwind ransomware is going up. And one of the things I see as an emerging risk is I'm seeing more and more financial institutions and credit unions, especially, they're funneling resources towards cyber resilience, towards cyber crime, towards information security. And I love that. But the problem is they're not adding resources. They're taking those resources away from existing risk structure. So we have this pot of money and people, we're going to move it over. So what's going to happen, I think, is as we're spending all this time and attention focusing on ransomware, these other issues that we maybe had under control, or some of these enterprise risks that we thought were stayed, as we neglect those, we're going to see those types of risk increase. And one of them, particularly that I'm very biased about, is business continuity, for two reasons. One, because of cybersecurity that we talked about, but I'm really seeing that climate change is driving FIs and credit unions in particular to reevaluate physical risk, because we're having more and more erratic and unusual weather. So you had in Canada in September, Hurricane Fiona was the most intense tropical weather system to ever hit Canada, caused $3 billion worth of damage. Here in Florida, most people are probably familiar with Hurricane Ian. That was in September. But then we had Hurricane Nicole in November, very late in the year, very unusual that historically a late storm is strong. And people were still dealing with the aftermath of Ian when Nicole came along. Even recently, where I live in the Tampa Bay area, we've had such weird and erratic thunderstorms that last week there was all these tornadoes in the area, which is very unusual for December, to the fact that a lot of the news stations had like people's Christmas lawn ornaments were flown all over the place. We've never had to contemplate, should I put my Christmas reindeer up, or are they going to literally fly? And so as this weather becomes more erratic, as climate change drives erratic weather, we're starting to see some credit unions think about, hey, my physical risk have changed. So maybe I have branches in areas that have historically never flooded. and now they're at risk of flood. Or I work with, credit unions in Canada that they never had to contemplate, do we have a hurricane plan? So I think as we kind of get comfortable with, well, we know what the physical risks are where we operate, so let's divert money to cyber. But as climate change and erratic weather keep changing, I think a lot of credit unions are going to be caught shorthanded when a huge weather event affects them. And look at, when we're recording right now, look at the cold weather that's occurring in large gaps. So last week there was a snowstorm that was, what they said, from Colorado to Minnesota. You have a winter weather system that's 1,000 miles wide. That's very unusual. And I think we're going to continue to see, those types of weather effects impact credit unions and their communities in ways that we've never seen before.
Yeah, that's a really, really interesting point. I think Filene Research did a paper on that as well. I'm sure you've seen about how credit unions can help mitigate that. But one of the things, and you touched on it a second ago or a bit ago when we were talking about brand and stuff like that, being able to serve your members, is a hot topic right now. Well, for a couple of years now, has been diversity, equity, and inclusion, of course. And but there are risks involved in not having some sort of plan around your talent management, and particularly the diversity, equity, and inclusion of that talent. If you want to pontificate a bit on that.
Well, I would love to. I mean, there's a couple of different ways you can look at it. I think the first is the moral risk of the whole point of credit unions. The way many of them founded is, there needs to be a way to serve the community that we live in, because these big banks didn't want to deal with farmers or people during the Depression or minorities. And so I think the first thing for credit unions to remain relevant, do you look like the community that you serve? And so we look at a lot of credit unions. What's the makeup of directors and above? What's the makeup of the board? And if they're either in a vertical or they're in a community, where's the difference there? I think you risk losing relevance with the community that you serve, and that's where you will see people go to a traditional bank, or everyone's struggling with the online financial institutions right now. So I have no branches, I have no overhead. Chime just offers loans and cards and accounts, and if you look at what their costs are in basis points, it's a fourth of everyone else's. So what's that relevancy? Are we truly serving our community by being reflective? I think the other thing, if you just want to look selfishly, if the entire executive team or the entire board looks and acts and thinks the same, doesn't matter what group, doesn't matter minority, majority, doesn't matter what it is, they're all going to have the same opinion. They're all going to have the same thoughts. And those are organizations that are really going to struggle with innovation. Fintechs like Chime and like other companies are going to continue to disrupt the payments industry, the loan industry. Any aspect of financial services are going to continue to be disruptive. And if you have your whole executive team all thinks the same way, you're narrow-minded one way or the other. You're not opening up to ideas of innovation. And that's why we've seen with a lot of credit unions, Sarah, as you know, membership declining, or like you said, the website, if everyone is C-level and above is an 85-year-old, they're going to say, oh, website's a necessary evil. That's bad for business.
Mm-hmm. Yeah. And actually it's interesting because you were talking about the innovation angle too, and credit unions in general tend to be risk averse. In this case, it feels like being risk averse is the risk. Would you agree?
Absolutely. You have to recognize when the market changed. And again, I hate saying this and I hate when anyone else says it, but COVID changed everything. Look at the restaurant industry. The percentage of people who ordered food online or ordered to go in 2019 versus now is astronomically different, to the point I work with a well-known restaurant chain. I can't say their name, but you would know who they are. They've now, if you look at their new restaurants that they're building, the footprint for the dining area is, I think they said 1/3 smaller. And the kitchen is 40% larger, because they understand now more and more of our business is coming from people who aren't eating in this restaurant. Mm-hmm. So that's, to me, that's not a risk. Some people would say, oh, you've been in business 70 years. Why would you change your model? It's not a risk if the market has changed. So these restaurants have recognized, hey, we need to be able to have more capacity for online ordering. Just like we're seeing a lot of credit unions say, hey, do we need to keep building branches, or do we need branches in certain areas? Maybe we look at by zip code, here's where we need branches, and we need to invest in online banking, in mobile tellers, in, remote tellers. I don't think it's a risk if you have a business case to support it. To your point, a lot of people, when they say they're risk adverse, they're adverse to change.
Right.
This isn't a case of, let's take all our deposits and put it in Bitcoin. Yes, that's a risk. That's reckless. But it's saying, okay, how can we get more market share in our membership circle? What are our members doing? Where they're going? Just like a restaurant. If we want to make it solely a kitchen, the customers are happy, revenue's coming in. That's what matters.
Exactly. Yeah. When I was with a certain credit union publication years ago, 08, 09, of course, housing crisis, and we were responding to that, as were our readers and our advertisers. And, I had people tending to be 55 plus, maybe. And as I near that, I don't want to say it, but no, I had people who would be like, oh, well, you guys must not be doing well because the magazine's so thin. It's like, no, it's our best revenue year. Some of our best revenue years, because we were making that shift to digital. And the magazine was thinner, but that's not where our audience was either. I mean, 2/3 at least at the time of our audience was online. So yeah, it's just paying attention to the signals that you're being given. And some of it seems obvious, but there's like that gut check that sometimes people can't get past the emotional ties to the history to be able, to that business model that needs to change with the times. No pun intended.
Well, I think the publishing industry, that's a great example. If you look at the organizations that have thrived online, thoughtfully behind a paywall, they have quality content, they have phenomenal UI, they have great UX, like they make it an enjoyable destination and somewhere where you're happy to pay for. We all pay for certain subscriptions to online content. There's been other huge, like Time Magazine, like some of these massive cornerstones of the 20th century chose not to adapt or didn't adapt well. And now do they even exist? And you're going to see, you see the same thing, look, with any business. It's not just credit unions. Look at the Fortune 500 or the NASDAQ 100. Look at the top 50 companies from every 10 years going back the last 80 years. They're all different. That's because companies either didn't respond to changing market, didn't respond to the times, or responded poorly.
And I think getting back to the point of COVID too, and digital service, and that being the new definition of service, which one has been affecting the American Consumer Satisfaction Index regarding credit unions, which has been down, I think, the last 5 years. But also we're comparing to broaden that, or bring your point back to the broader market. we're comparing service to service. We're not comparing our credit union to our bank necessarily. It's these those experiences that we became tied to during COVID, like using Netflix, using Amazon. And so then you go to your credit union app or whoever's app, and it's, why isn't this working as easily? This is stupid, though, you know, and that creates an emotional bond that you don't want. You don't want reflected in your brand.
Exactly. Because I think a lot of credit unions think, again, going back to the car loan analogy, well, we'll beat the bank on rate. And that's why someone will sign up with you. And absolutely. But what they forget is then I interact with you 36, 48, 60, or even 72 times making those monthly payments. And I may have initially gone with a credit union because the rate was lower. But if making my payment and getting my statement is frustrating for 3, 4, 5, or 6 years, that member will not go with a credit union again, because that extra quarter point, it's not worth the hassle factor to them.
Right. Or if that's the only engagement, are they going to, I mean, a lot of credit unions are kind of, and I think it seems like it's shifting, but they don't want to come across as salesy. But if you're not helping those members along the way, checking their credit report and being like, hey, you've got this at XYZ credit card or XYZ mortgage, and, you know, we can help you out there, and providing, not even that direct, but providing information on how, just generic, how do you lower your mortgage payments? How do you, treat your investments during an economic downturn? The kind of information that builds trust online, creates that human experience, or somewhat humanizes the digital experience, so that you can, build trust.
And this goes back to what you were talking about with the brand recognition and awareness. If I trust you and you suggest something to me, I don't see it as salesy. So I've been taking my cars to the same mechanic for 10 years. And 9 times out of 10, he was like, you're good to go. So last week when he said, oh, your car needs this, that, and the other, I didn't shop around. I didn't even ask him about it. I was like, okay, go ahead and do it. And I paid it for him because we built that level of trust.
Right.
So to your point, if I have a credit union who I have one product with and is looking out for me and I feel good about them, then when you suggest a second product, it's not a hard sell. It's like, oh, hey, you should consider this as well because it's beneficial to you. Mm-hmm. Those sales are built on trust.
Trust and help. You help first, right? Because otherwise you're at risk of not growing your business. And then what does that do for the rest of your members? You're responsible to an entire membership, like just, for example, being an employer, feeling that responsibility, to keep everybody up and running, not just a certain type of member, or, and obviously you can't be all things to all people, but, honing in on who that ideal member is. And it may be a younger member for future growth, and so, really getting that brand down and making it the corner piece rather than your dang rates.
Exactly. It should be the foundation.
Anybody can come undercut your rate. Anybody.
Exactly.
Because as you mentioned, we'll get back to that point as well. You mentioned, the cost of funds at a Chime or something like that is so much less, because they, or it can be so much less. And right now, in particular, credit unions are fees. Some of them, or a lot of them, are heading there into a liquidity crunch.
Exactly.
When 2 years ago couldn't get money out the door. And now, that 300 basis point shock doesn't seem so crazy. So, okay. Let's wrap it up here with what are you expecting in 2023? Anything in particular for next year that you think are going to be the top risk issues?
So I really think the Department of Justice is going to continue to bring the hammer on financial institutions. You know, they announced last year that they plan to greatly increase enforcement actions. They released a memorandum in this September expanding on that. They've made it very clear you better be voluntarily self-reporting. And if not, you look at the fines that have come out just in the last 3 days. Wells Fargo at 3.7 billion, Honeywell at 160 million. They're going to continue to be very aggressive and go after very large dollar fines. And I've even seen them at some smaller credit unions. There was one earlier in the month that got hit with a $400,000 fine. They are aggressively looking small to big for compliance enforcement. And a lot of it is, I'm not going to say ticky-tacky, but there was one organization that received a fine, not because they did anything dirty or illegal. They didn't follow their own investment policies. Didn't result in anyone getting hurt, or it wasn't because of discrimination, but they got fined because the federal government said, you have these policies, you didn't follow them. And so I expect that's going to continue significantly in the first and second quarter of next year.
Yeah, I don't know. Do you know? Did that organization get like a heads up, like any kind of yeah. I can't think of the word, but yeah, did any of the regulators, they weren't like, hey, you might want to make sure you're in line with this policy?
We've seen under this administration a very big change in terms of, hey, we'll give you a warning, hey, next time you're in trouble, to no, it's going to punitive phase right off the bat. The Department of Justice has been very clear about their enforcement actions. They've asked Congress, if the latest omnibus bill, there's a lot of money in there solely focused to enforcement actions. So they're going to back it up with people and resources.
Well, thank you, James, very much for joining me. Appreciate it.
Yeah, thanks for having me on, Sarah. I appreciate it.
Absolutely. Have a great 2023.
Thank you, you too.